Hello everyone, welcome back. The most obvious change in the US stock market recently has been the very strong rebound in areas such as QQQ, semiconductors, and data storage. So is this a buy the dip opportunity? Are semiconductors about to lead the market again? Has AI hardware finally stopped falling? My view is this. In the short term, the rebound is worth watching, but it is still too early to call it a confirmed right-side reversal. What truly deserves attention is whether capital is starting to rotate away from hardware and into AI software and data services. Because on the surface, this market move looks like a rebound in technology stocks. But underneath, the real story is that the structure of capital flows is being rearranged. Let's first look at capital flows. At the sector level last week, the main areas with real inflows were financials, energy, and healthcare. As market volatility increased, capital did not completely leave the stock market. Instead, it looked for more stable areas with stronger cash flow support. This confirms the rapid capital rotation logic we have been emphasizing. However, it is important to note that the flow strength in financials and healthcare has already declined compared with the previous week. The change that truly deserves attention is still happening inside the technology sector. But this time, it is not AI hardware, it is software. These were the top-ranked subsectors by capital flow within technology last week. First, cloud and AI infrastructure services. Second, data and content management services. Third, cybersecurity. Fourth, enterprise workflow. These areas share one common feature. They are all real-world use cases for AI. We have repeatedly emphasized that AI is no longer only a chip company story. If companies want AI to truly enter their business processes, they need data management, cloud service monitoring, cybersecurity, access control, and enterprise workflow systems. This is why companies such as Snow, DDOG, and MDB are starting to be repriced by the market. For example, one of the most direct catalysts behind cloud and AI data infrastructure services was Microsoft's earnings report. It showed that enterprise AI spending is beginning to flow into platform companies that help businesses manage data, monitor cloud services, and connect AI applications. Take data management services as another example. For AI to truly work, it first needs to read, organize, and access a company's own data. If the data itself is not well managed, even the strongest AI will struggle to create real value. Cybersecurity services follow the same logic. As AI agents continue to develop, corporate systems will expose more interfaces and make more frequent permission calls. Security demand will only increase, not decrease. The same applies to enterprise workflow. The market previously worried that many SaaS products would be replaced by AI. But now the market may be gradually realizing that software controlling enterprise workflows, code development processes, and permission systems will not easily disappear. In fact, for AI to complete tasks, it often needs to connect to these systems. Therefore, this round of capital flow changes points to a new stage. AI hardware is responsible for building the infrastructure, while AI software is responsible for turning that infrastructure into enterprise productivity. So how do we identify the next leadership sector? It needs to meet the following conditions. First, capital flow across the entire industry has already turned positive. Second, it is not just one or two stocks rising. Most stocks in the industry are moving higher. Third, flow strength is not slowing from a high level, but continuing to build. Based on this standard, the software areas mentioned above have already met at least the first two conditions. However, whether their flow strength can continue to increase still needs more time to be confirmed. Next, let's look at the AI hardware area that everyone is most concerned about. QQQ, SOXX, and data storage names did see a strong rebound last week, but a rebound is not the same as a reversal. Many people see a rebound and immediately want to jump in. But a truly mature trading system does not buy simply because prices are rising. It first asks, where is the risk in this trade? How much potential upside is there? Is this risk worth taking? For investors who already have a long-term core position, there is no need to chase every short-term rebound. What matters more is waiting for a right-side opportunity with a higher probability and a better risk-reward ratio. The same logic applies to semiconductors. SOXX is moving very similarly to QQQ, and the overhead resistance is also fairly clear. A more prudent approach is to wait for the price to truly break through the resistance zone, absorb the trapped overhead supply, and open up new upside space. Then we can see whether there is a pullback confirmation and a better entry opportunity. There is an important principle here. Support and resistance levels are not mechanical buy or sell points. They are observation zones. When price reaches resistance, it does not mean you must short it. When price reaches support, it does not mean you must buy the dip. What we really need to watch is what happens after price reaches these key areas. Does momentum fade, or does price break out on strong volume? If price enters a resistance zone with very strong momentum, gaps above that zone on heavy volume, and then holds above it for several days, the move may be shifting from a rebound into a reversal. Right now, the stocks most worth adding to the watch list are software names that remain strong during a broader market pullback. Here, one representative name deserves special attention: Snowflake. Snow has continued to see capital inflows over the past few weeks. Even as the broader technology sector pulled back, it has maintained a relatively strong trend. On the weekly chart, it is breaking above several previous descending resistance lines, one after another. We should also note that its base structure is relatively large, and there is still overhead supply that needs to be absorbed. But from another perspective, the longer and larger the base, the stronger the potential upside may become once a real breakout is completed. Therefore, Snow should be viewed as a representative stock in the cloud and AI data infrastructure space. We can continue to watch whether it can become a new market leader in the next round. Every market pullback is a good opportunity to search for the next round of leaders. True market leaders do not only appear when the market is hottest. They often start showing relative strength, capital inflows, and early breakouts while the broader market is still correcting. So we need to establish 3 new ideas for looking at the market from here. First, use this market pullback to look for potential leaders in the next round. Second, the AI hardware space can still be watched, but there is no need to rush into a heavy buy-the-dip position. Third, there are still areas of the market moving higher, but truly high-quality trading opportunities are not abundant. At this stage, reducing trading frequency is a way to protect both capital and energy. This is a better time to build a watch list, wait for industry-level flows to continue strengthening, wait for individual stocks to break through key resistance, and wait for volume to confirm the move. The next round of market leaders may not come from the area with the sharpest rebound. They may come from the areas that hold up best during the pullback, turn positive in capital flow first, and complete breakout confirmation first. A truly good trade is not about participating in every rebound. It is about acting when the risk-reward setup is at its best.